Hello everyone. Today in this lecture we are going to learn about factoring. So before starting with the proper definition of factoring, let's understand what do you mean by word factoring. Okay. Now suppose this is a company and this is a chocolate manufacturing company. So since the company is manufacturing the chocolate, so that means the company must be having some customers. So let's say this is the customer for this chocolate manufacturing company. Now this company is selling goods and services to the customer. That means if this is a chocolate manufacturing company, the company is selling the chocolates to this person, and after selling the chocolates, the company is sending the invoice. So once the company has sent the invoice, that means company has sell its product. Now the company is demanding for its money. But somehow this customer says that this customer does not have the money right now. So the customer wants a credit for 2 months. Now the company has an option either to say no or to agree with the credit policy. That means the company has an option whether to say that no, I don't want to give the credit, or the company can give the credit. So if the company is not going to give the credit, that means company is going to lose the customer, because right now customer does not have the money to repay it back to the company. So somehow company agrees to give the credit. Now, if the company is agreeing to give the credit, that means that this customer is going to pay back the company after 2 months. Now, suppose within that 2 months time period, company got a very big order for the chocolates. Now, the company does not have the money to purchase the raw material, because the raw material, or you can say the company's amount, is being blocked with this customer. Company has sold the product to this customer and this customer has not paid the money back. This customer is going to pay it after 2 months. So that means there is a credit policy for 2 months. So till 2 months the company's amount is blocked. That means company's current capital, or you can say current asset, that is the cash that is being invested in the purchase of raw material, manufacturing of the chocolates, is being blocked for the 2 months. Now when the company is getting a very big order, so now the company has two options: either to approach to the bank and take the loan to purchase the raw material, or to say no to the order. Now if the company is going to say no to the order, that means company is going to lose some profit. So company has to borrow the money from the bank. If the company is going to borrow the money from the bank, company has to pay the interest on that money. That will increase the cost for the company. And if the cost of the company is increased, that means the profit for the company will decrease. Now the problem is what to do, because the company does not want to lose the order also. That means company want to fulfill the demand for that order. Now what the company does, company approaches one financial company. Now this is a company who is ready to give the money to this company. Now when the company is giving the money to this company will charge something, either the interest or some fees, and this company will also charge some collateral. So what does this chocolate manufacturing company tells the complete situation to this company, that he has sold the goods to this customer and this customer has asked for the credit. So company has given the credit of 2 months to this customer and this customer will pay the amount after 2 months. So what does the company says? Company sells its invoice to this financial. That means company sells the invoice that is for this customer to this financial company, and this financial company agrees to pay the money to the chocolate manufacturing company so that the company can purchase the raw material. Now from this situation, one thing is clear, that if this chocolate manufacturing company has not given the credit to the customers, in that case the company can fulfill the demand of the order and company has the money to purchase the raw material. Because the company has given the credit to this customer, so that's why company has to approach this financial. So I can say that this financial company is a factor for a company who is helping the company in the difficult times when this customer has not paid the amount. So I can say that this credit policy, that means when the company has given this customer a credit, or I can say that when the company has sold the goods on credit, that's why the factoring company has taken its birth. If the company has not given the credit to the customer, company have not approached to this financial company, that means this factor company. So I can say that credit sale gives birth to factoring. Now what does this factor, this financial company is known as factor, this will give 70% or 80% of the invoice amount as an advance to this company. Suppose the company has sold the goods worth rupees 1 lakh to this customer. So what the company will do? Company will sell the invoice to this factor company, and this factor company will pay 70 to 80% of 1 lakh rupees to this company. Now, since the company has sold its customer to the financial company, now this financial company will follow up with the customer about the amount. Now what does this customer will do? This customer will pay the amount to this factor company after 2 months. Now after 2 months, when this factor company will receive the amount from this customer, this factor company will deduct its fees and pay back the balance of 30% and 20% to the company. So financial company pays remaining 30 to 20% of the invoice in cash after deducting his fees. So this is the complete process of factoring. Now let's move up with the definition. So I can say that factoring is a financial transaction and a type of debtor finance in which a business sells its accounts receivable to a third party at a discount. Now let's learn how many types of factoring are there. So the factoring is divided into 8 parts. The first is known as recourse factoring. Second is non-recourse factoring. Third is domestic factoring. Fourth is export factoring. Fifth is disclosed factoring, undisclosed factoring, advance factoring, and maturity factoring. Now let's understand one by one what all these types of factoring are. So first of all, let's come with the non-recourse factoring. Now as I have already discussed that whenever the factoring takes place, there must be a credit sale. There must be one customer will be there, one company will be there, that means the firm who is selling goods to the customer, and the third party will be the factoring who is financing this company. So let's say this is my customer who is buying goods and services, and this is my firm who is selling the goods to this customer. Now once this company is selling the goods to his this customer, so it's obvious that this firm will demand for its money. So let's say this firm has sold the goods to this customer worth $10,000. So now this company is demanding for $10,000. But what this customer is saying, the customer is saying that I don't have money right now, I'll pay you after 2 months. That means this customer is demanding for the credit. Now this company, this firm agrees to give the credit to the customer. So this customer is now give back the money to the firm after 2 months. Meanwhile, as I have already discussed, this company has a demand for a new product for which he has to purchase the raw material for which it needs the money. So again, now it approaches this factoring company for the amount. Now this factoring company says that yes, I am ready to give you the money, but not the complete amount. I'll give you something in advance. So that means this firm needs 10,000. So this company is not going to pay 10,000. The company will pay 8,000 now. As we have already discussed in the previous slide, the company will pay 70 to 80%. So this company will pay 8,000 to the firm. Now suppose after 2 months, this buyer says that I don't have money to pay. I am bankrupt. So I cannot pay the money to you. So now this factor, if this factor is not going to pay the money to the factoring, this customer is not going to pay the money to this factoring company. Now what does this factoring company says? Or we can say what does this factoring company does? So this factoring company says to the firm that don't worry, I will protect you from the bad debts. Now this factoring company is saying I have already paid you 8,000, so don't worry about the amount. It's my duty to recover the money from this customer. You don't have to worry. I'll protect all your bad debts. And I will handle all your collection. That means now it's my responsibility to collect the money from this customer, and if this customer turns up to be bad debts, you are not in a loss. I am taking the risk. But if this factoring company is taking the risk, it's obvious that this factoring company must be charging some huge amount of fees. So because as we have already learned in the previous videos, as the risk increases, returns also increases. So that means if this factoring company is taking the risk, so this will demand more fees. So in recourse factoring, the factoring company pays the amount in advance to the firm. It also protects the firm from the bad debts. It also handles the collection, but it charges more fees for that. Next is recourse factoring. So let's take with the same example. This is your buyer, this is your seller. If the seller is selling goods to this buyer and demanding for $10,000. This customer again says that I want the credit for 2 months. So it approaches to this factor company, and factor company pays 8,500 right now. But at the time of after 2 months, this customer says that I don't have money right now to pay. So now if this customer is not going to pay the money, what should we do? So this factoring, as we have already discussed in the non-recourse factoring, that this factoring company says that I'll protect you from bad debts and I'll handle all the collections. But in recourse factoring, this is not the case. In recourse factoring, this factoring company says that to the firm that wait, I am not going to protect you from the bad debts. If somehow this customer is not going to pay back the money, that means if this customer becomes bad debt after 2 months, now it is your responsibility to pay back my 8,500. Since this factoring company has paid 8,500 to the firm as an advance, and if this customer becomes bankrupt, so this seller is going to pay back 8,500 to this factoring company. Now in this case, this factoring company is not taking as much risk as that was there in the non-recourse factoring. So it's obvious this company will charge less amount of fees. Now next is disclosed factoring. So again, this is your customer, this is your firm. The firm is selling goods. The firm is demanding for $10,000. Customer is saying I am going to pay you after 2 months. It's again approaches to this factor. Factor pays $8,000 to the firm. After 2 months, this customer again says I don't have money, I don't want to pay it, I am become bankrupt, so I cannot pay. So this factoring company says that I'll protect you from the bad debts, as that was the case in non-recourse factoring. But this protection is optional. It's completely optional on the factoring company. They can agree to protect you from the bad debts, they cannot. And in this case, the factor company, that means this customer is aware about this factoring company. This customer knows that I am being sold to this factoring company. My invoice is being sold to this factoring company and I have to pay to this factoring company. That's why it says that this is a disclosed factoring. That means this firm, this seller is going to tell this buyer that I am selling your invoice to the third party and now you have to pay to the third party. You don't have to pay the bill to me. And this seller controls collection, sales ledger and credit control. So that means we can say that in disclosed factoring, the name of the factoring company is known to the buyer. Now non-disclosed factoring. Everything goes same in the non-disclosed factoring. The only difference is that this buyer is not aware about the factoring. Customers are not told we are outsourced. That means the firm is not going to tell the buyer that I am outsourcing you. That means now I am not going to collect the money from you. This third party, this factor is going to collect the money from you. You don't have to pay the money to me. You have to pay the money to the factoring. This customer is unaware about all these things. Now, next is advance factoring. Now, this is your Buyer, this is your seller. This seller is selling goods and demanding for $10,000. This customer again says, I'll pay you after 2 months. So what does this firm is saying? Firm is approaching to this factoring company, and this factoring company is paying 8,000 to the seller as an advance. So this 8,000 is an advance. Now, if after 2 months this customer is not going to pay back the money, so what they will do, this factoring company will charge interest on this advance payment. And if this buyer pays back the money to this factoring company, then this factoring company is going to deduct its fees and pay the balance to this seller. And if this factor becomes bankrupt, then in this case, this seller has to pay back 8,000 to the factoring company. Now, maturity factoring. Now, again, this is your buyer, this is your seller. Seller is selling goods to the buyer and the seller is demanding for 10,000. Again, the customer is saying, I want some credit for 2 months. So, this seller agrees. But over here, when the seller is going to approach to the factoring company, this factoring company is saying that I am not going to give you the advance. I am going to give you the money once this customer is going to pay back me the money. So, in the maturity factoring, this firm is not going to get any money in advance. It will get the money after the maturity period. The only thing is that this factoring company is going to collect the money from the customers. Now, domestic factoring. As you are aware that domestic means when the goods are being sold on credit within the nation, within the boundaries. So as we have discussed in the starting of the lecture, this is your company, this is your customer in India, because we are doing the domestic factoring. So this is a customer in India. Company is going to sell goods and services to the customer, and customer is demanding for the credit and company is giving the credit. So the customer will pay after 2 months. So what the company will do, if the company is in a requirement of the money, company will approach to this factor and company is going to sell the invoice. That means, or you can say submit the invoice and all the shipping document to this financial. This financial will pay back around 80% of the invoice as cash in advance to the company, and this financial will follow up and collect the money on the due date from the client. On the due date, on the due date, this client is going to give back the money to this financial. This financial is going to pay balance 30 to 20% of the invoice of the cash after deducting his fees. So this is the scenario of a domestic factoring. And if this customer is not going to pay back the money to this financial, or you can say this factoring company, this company is going to pay back the 80% on the maturity date. That means if this customer become bankrupt, so whatever advance this company has taken, they have to return it to the factor. Now the next is export factoring. Now, as the word export factoring means that company is selling the goods on credit to some customer who is not within the boundaries, they are outside the boundaries. So that means the customer is in some foreign nation. So this is your company, the customer is in a foreign country. This is the India factoring company and this is a factoring company in buyer's country. Now this company is going to sell goods and services to this customer who is sitting in the foreign. And if this customer is asking for the credit, so what does this company doing? Company is submitting the invoice and shipping documents to the factoring company who is there in India. And this India factoring company will pay 90% immediately to the company, or you can say to the exporter. And this Indian factoring company is going to send the documents to this customer who is sitting in the foreign country and inform the invoice detail to the factoring company in the buyer's country. And now this factoring company who is there in the buyer's country will follow up and collects the money on due date. Once this company has collected the money on the due date, this company will remit the money on maturity to the factoring company which is there in India. Now, if the Indian company is going to receive the money, they will pay the balance and release all the shipping bills. So this is the complete process of export factoring. Now let's revise the key points. So as we have already discussed, factoring is a cheaper source of short-term finance as compared to bank loan. Sometimes risk is borne by the factoring company, as we have done in the non-recourse factoring. Factor helps the firm to concentrate on the management of its business. That means now the company does not have to bother about the customer, whether the customer is going to become bankrupt or how to collect the money. Everything will be taken care by the factoring company. It reduces the other administrative costs such as collection costs from the debtors, because now the factoring company is taking care of all these things. Factoring helps the firm to know about the credit worthiness of the customer. So now the factoring company also tells the selling company that whether you have to give the credit to the customers or not. This is the expensive method of collecting the finance, because if the company is going to borrow the money from the factor, they have to pay some fees. Handling of customers by the factor may spoil the relationship with the customer. And lastly, in case of recourse factoring, the firm could suffer from the bad debt liabilities. In these, debts become the firm's responsibility. Because in the recourse factoring, we have learned that if customer becomes bad debt, so customer has to pay back the money to the factoring company. That means whatever the advance the firm has taken, they have to pay it back to the factoring company. So that's all in factoring. For further reference, you can refer my book, Financial Management. Thank you.